Welcome to this presentation on equity factors and a discussion on factor rotation. With us is Milind Sharma of Quantz, and I'll chat a bit more about Milind in a minute. I'm David Rudd of Sigma Analysis and Sandbox Limited. Sandbox is a highly graphical portfolio construction app with some unique data, including Quantz's factor data and some unique visual tools. For 20 years, Milind Sharma of Quantz QMIT has been immersed in developing unique equity factors and unique takes on equity factors. And Quantz QMIT provides actionable signals on these factors on a subscription basis. At the end of the presentation by Milind, we're going to spend a few minutes building a couple of factors on the Sandbox app and looking for correlations and some interesting characteristics that factors have. Anyhow, over to you, Milind.
Well, thank you for the kind introduction, David, and really such a pleasure and privilege to join your Sandbox webinar today. Greetings to all the folks up in Canada. I'd love to connect with you offline. So yeah, why don't we get started on today's webinar, which is really about kind of, I've always said that the holy grail of factor investing is regime dependence. And, what we're seeing right now is a massive sort of regime change, kind of a factor rotation going on from, value to, from momentum to value. So that's kind of what we're going to talk about broadly, and then at a more micro level, we'll sort of touch upon some of the recent trends in Q1 in particular, and how we got there based on what happened last year. So let's just dive right in. In terms of, how we set this up, I mean, basically what we're looking at is over 600 factors. These are all equity related, North America. Good news is all the Canadian dually listed companies are in there. We can actually do all of TSX separately, but at the moment to just kind of, keep the currency effects at bay, we've only tackled the dually listed Canadians, ADRs, and, other, basically ADRs and Canadians in conjunction with the more liquid institutionally tradable names. So the universe for this is roughly 2,700 names as of today, if you looked at our FTP file feeds. And essentially for those roughly 2,700 names, we're populating 600 plus factors from all the obvious well-known kind of public databases. And then we run our sort of magic on that in terms of the machine learning enhanced, ensemble learners, and, create these various composites. So what we're really trying to do is to distill the whole kind of tame the factor zoo and create some sense out of all the chaos of the factor world. Is it significant? Is it an anomaly worth paying attention to? So, well, the good news, we got 21 years of pretty clean data now. And once you run that across these 600 factors, you come up with 18 composites, and you come up with kind of 18 sector neutralized versions of those. And then we, just look at basically in terms of tracking the factor performance, how is it defined? We basically define it as the very best names up at the top and then the worst names at the bottom, right? So even though we're actually populating the entire list and every one of those roughly 2,700 stocks gets a rank, in terms of what defines the factor performance is really the top and bottom names, right? So the cheapest stocks at the top will be your value sort of longs, and the most expensive ones at the bottom will be the shorts. And that's your roughly 125 names on each side, which corresponds to top versus bottom 5 percentile. And these are all, well-grounded in intuition. So these are fundamental or technical factors, things that every portfolio manager knows about, and, where we would expect some kind of persistence in the factor performance, as opposed to, these are not meant to be purely mathematical constructs. You can turn them into pure factors, or, kind of more statistically oriented versions using principal components of such, where, you can kind of project the factors and strip out the collinear, kind of strip out the collinearity and orthogonalize them. We're not going to do that here today. That's more interesting for attribution. But what we're trying to do is to create the best sort of linear combination of factors that allows you to express any view on equities and also gives you really high octane performance. Because once we do that, then we can combine them and create lots of powerful hedge fund signals. And we'll see how that works in just a second. But first, how do we create and define these ensembles? So the idea is very simple. You want to span the universe of all the obvious themes, as I mentioned, right? So what do people look at? They look at things like deep value. That's basically your Farmer French high minus low, right? So it's essentially price to book, things like that. You look at relative value, and that's more the other, PE type of ratios, right? But actually, we might have dozens and dozens of flavors of, enterprise to this and EBITDA to that and free cash flow to that. And so, we're basically spanning all the possible combination permutations you can really think of, and that's how we get up to the hundreds of factors, right? And so we're doing that across DV and RV, which turns then into the value composite over here, number 5 on the right side of the composite signals, right? And then similarly, we do that for the growth momentum theme. So inside momentum, you've got the basic price momentum, which is your traditional Jagdish-Chitman type of factors, and then the enhanced versions that we track, which are much better. And then you've got a couple related to earnings momentum, that's your analyst revisions, and then the analyst ratings and targets. So that's sort of the price momentum, the earnings momentum, and then you got the growth, right? So there's this historical growth bucket. So you put all that together and you get number 6, which is your growth momentum composite. So you start to see what's going on, right? So you can take all the value stuff, that becomes one composite. You can create a growth momentum composite. You can create a quality composite out of 6 of these qual buckets: earnings, quality, leverage, prof, capital usage, stability, efficiency, et cetera, right? And of course, once we've done that, then, you might say, well, but a lot of PMs like to track GARP, growth at reasonable price. Well, what's growth at reasonable price? That's basically just taking this growth momentum composite and combining it with valuation. And so, that's number 8, ValMo. That's our GARP. You can easily create a QGARP. So we also track QGARP, which is, okay, well, now you got GARP, let's throw in a quality component, right? So you start to see what's going on. We've got this very powerful Lego set, and you can basically create any kind of a, you want to build a house with, 3 rooms and 2 bathrooms, fine. Or you want, granite countertops. I mean, you can do all of those little combinations and permutations, right? Once you've got the basic pieces in place. And that's basically what's going on. Is the famous 5 has the best known 5, sort of the Farmer French plus Carhartt plus, your quality sort of component, quality minus junk, and one more, right? So the low vol, what has been called the betting against beta factor and things like that. So you get the famous 5, sizzling 7, same idea, except now we throw in reversals. And if you take this to the extreme, of course, that's enterprise 18. You just take all 18 of them and just sort of equal weight them, right? Okay, so that's essentially the factor library, all the smart betas and how they get aggregated into the various hedge fund signals, and we'll see why this is such a powerful construct. But let's remind ourselves about these so-called ensembles and why we go to all of this trouble. So we've actually tried this using a lot of the newfangled techniques, like, your bagging and boosting and all those types of things, right? It turns out, of course, those are a little harder to explain and much more opaque. So we're just going to stick to simple stuff. Let's suppose we've got a dozen flavors of profitability within quality, right? So you got this theme of profitability, which of course everybody understands, something like return on equity or an ROA or or a CFROI or a cash flow something, a crocky, rocky. There are so many, manifestations of this type of profitability, right? So our job is to, first of all, cover all the bases. We try to find all the ratios that correspond to that. And then we just slice and dice it different ways, right? So the first obvious is to say, well, if I don't have an opinion, let's just take all of them. All right, so you equal weight all the factors. The second is, well, maybe we can find a subset that does much better. So in any given cohort, it may turn out that there are some good factors and some bad factors. So if you take the 3 best ones in terms of returns up until that point, obviously we're not cheating. We're not looking back after 21 years and say, oh, let me just pick the best 3 factors that I know now. No, we're doing it along the way. What you have to do is every month you look and say, which 3 life to date or 3 years trailing, 5 years trailing, whatever your criteria is, what were the 3 best factors today? Let me equal weight those, or let me take the 3 best in terms of Sharpe, or let me take the best in terms of risk parity up until time t. So that's how you avoid look-ahead bias. That's a very important thing to bear in mind. And that's why we call these, we create a distinction between the best flavor of the month, which is a strategy that's devoid of look-ahead bias. So in any case, so you create all of these composites, right? Equal weight them, take the best 3 by Sharpe, by return, risk parity, or try to maximize Sharpe. So these involve a little optimization. So that's what's going on, right? So you train this ensemble learner on the whole 21-year history, the window that keeps expanding over time. And this is what happens. The output's showing you that actually by virtue of taking all these different flavors of quality and kind of equal weighting them, you can really dramatically increase the outcome. So going from a simple ROE, which gives you a pretty decent 8%, you can get it up closer to 21% by taking our ensemble learner and the best flavor, which is this, equal weighted. So the vol comes down, the return more than doubles. You've got the Sharpe has now, gone up pretty dramatically, almost quadrupled from 0.35 to 1.25. The Sortina has really gone up pretty amazingly from 0.6 to 3.5, and you get the idea. Same thing down here in capital usage is another smart beta where we, usually people look at something simple like cash to market cap or assets, like, how much cash does Apple have on their balance sheet? And that's a capital usage or cap structure decision on part of management that, they choose to have a lot of cash and still issue debt and buy back stock. So all of those things figure into this equation here, into this particular cohort and how we create the composite. And in this case, you can see something simple like cash to assets or market cap doesn't do a whole lot. In fact, this particular naive factor has been compounding minus 3% over 21 years annualized. So pretty bad. You'd be steadily losing money. Whereas if we just took the top 3 flavors in this cohort and equal weighted them, we get a much better outcome. So we're basically improving this outcome by about 17% annualized, and you get a much better Sharpe and Sortina, right? So that's the idea. Same thing, you can do this for PE and substantially improve the outcome using max Sharpe. Looks like in this case, max Sharpe is the right answer. In the case of deep value, which is your farmer French high minus low, you get your improvement from price to book, which is really kind of decayed to almost nothing. And I suppose this is because now that value has been very well known for such a long time, and everybody looks at book value and tangible book and this and that. Simple price to book is pretty well armed. And, you really have to work hard to kind of improve it, but it looks like there is plenty of juice here, and you can get it up to a good 13% improvement by virtue of doing what we've tried here. So why don't we just summarize this whole picture, and you can see now that if you line up all the 18 smart betas in terms of the annualized spread returns, and this is basically long minus short every month, and you keep rebalancing, right? So, and by the way, the little nuance here, there's 19 years of monthly data. So we've done 19 years starting with the NASDAQ crash in January 2000, going up until the end of 2018. And the last 2.25 years are actually live daily observations when we've been publishing these live as QMIT, and so QMIT has officially been sort of, people have been trading them, kind of getting these signals. So that's sort of the live mode. Now we were, as a fund, actually collecting the data live prior to that as well, but that's a slightly different story. So we've now got 21 years of observations for all of these 18 smart betas corresponding to the time that I've been running money in various forms, because I've deployed these factors across my hedge funds and previously at the prop desks at Deutsche Bank, at RBC, at, a lot of the mutual funds over at Merrill Lynch. So there's pretty good evidence to support, and of course now a lot of people are doing factor investing, so this is not an outlandish claim, that there is something to be said for these factors, right? So you can see that clearly on a trailing 21-year basis, there's enormous evidence from the T-stats and ICs I'll show you, from merely the spread returns and the Sharpes and Sortinas. I mean, some of these things are 3.5 Sortino, which is not too shabby. There's something going on. Interestingly, in many cases, and this is partly because of the Fed's, policies of late in the last roughly, 12 years since the '08 crisis, we've seen so much stimulus that it's gotten harder to short things, and so the long side mostly dominates the returns in many categories. In fact, in some you'll notice that the shorts are strictly detracting. So you take something like short interest, for instance, and this is because after the GameStop madness, we gave up decades of short interest returns in that 1 month. I mean, essentially, the long side of this signal does extremely well. So you get 12% here, but the long short doesn't look that smart, that great on a market neutral basis.
Milind,
Sorry.
Yeah. Now, you touched on it, the activity of the Fed late, obviously since the crash of 2008, and more recently, the obvious acceptance by the marketplace about the inevitability of MMT, which is liquidity and credit extensions till the end of time. Are we seeing anything? In fact, there's probably since the summer or since the U.S. presidential elections that is interesting and significant. As someone said to me the other day, once you commit to MMT, you can't uncommit. You've got a tiger. You have a tiger, and there's a sense that over time this could be very, very, very significant. I'm not going to make any editorial on whether it's good or bad, but it will be significant. And do you see any early trends happening? I'd like you to touch on that if you could.
Sure, absolutely, and thank you. Well said indeed. I mean, that's a very profound observation. Clearly, the consequences of this confluence of unprecedented monetary and fiscal stimulus is something that we're going to be living with in our lifetimes. It's almost as if the plunge protection team has tried to banish the business cycle here, and we'll see how. Yes. But I'm going to actually get to that in just a second. Once we look at the heat maps, you'll see how that sort of shows up, because you can really see the money sloshing around in the risk on, risk off themes, right? So essentially what happens is when you've got two-way market pricing, price action, you see that in the risk off episodes, and then, all the stimulus sort of comes flooding in, and then the risk on takes off again. So we'll see that in just a moment. But let's just wrap this up here. So, quants like to look at the Sharps and the Certinas. So what we do is we also show it against a benchmark. So for, looks like our best smart betas here might be leverage and profitability and low vol, et cetera, right? And these are beta, not dollar neutral, by the way. We show naive benchmarks. So for leverage, it might be, debt to equity. For profitability, it's return on equity and so on, right? Something very sensible that everybody can agree on. And you can see in that pretty much every case, we've dramatically outperformed, like the Certinos here for some of our smart betas are really off the charts, right? So they're pretty impressive compared to the naive benchmark, which is often negative. And then we do the same for the combo signal. So as I mentioned earlier, once you've got these high octane smart betas, and doing simple combinations of 5 or 7 or 14 or 18 actually gives you something pretty incredibly powerful, because they're less correlated. So you're getting this gigantic sort of diversification and correlation boost here. And that's really what's driving the Certinos up to 5. For a couple of these, you can see they're the Sharp heads north of 2, and the Certinos almost up to 5, which are not too shabby. Quants also like to look at ICs and T-stats. So we just show them here. You can look at that later. And, they're all pretty, I would say, impressive. You got T-stats going up to 20 and 30, ICs of 3 and 4, not too shabby at all. Turnover is something institutions care about. Obviously, the purely fundamental signals have pretty low turnover, like stability and dividends, and some others have much higher turnover. So we've now set the stage in terms of the basic information we need to actually dive into what Dave was hinting at, that, how does all of this factor rotation reflect? How does the cyclicality of the factors reflect the underlying, change of sentiment in the economy? So if you look at last year, where did we end? Last year, of course, it's not a secret that anything relating to value was down. So you can see value small caps were down substantially, but it was overall kind of not surprisingly because of the COVID crash, right? I mean, the dominating theme due to the crash was still more of a defensive outcome, where more aggressive factors like value, small caps were down on the year substantially, and profitability, very defensive, was up. Momentum, which is generally defensive and risk off, is our momentum almost finished at 40% here, enhanced momentum. This is despite the November crash I'll talk about. And then, you had some other things like very defensive stuff like the stability and low vol, et cetera, that still delivered pretty well. And the one outstanding, sort of the one that really pops out, is this 109% on reversal. So basically our proxy for mean reversion, or stat arb, if you will, the simple top minus bottom of this stat arb theme actually did extremely well, even though a lot of quant funds, some very prominent names were down 20-30% last year. And I think that was largely because of the over-reliance in value. So some funds had a pretty explicit bet on value last year. Now, what's interesting to note is if I go from end of last year to Q1 of this year, the heat map pretty dramatically flips. Okay, so you'll notice that at the top we had value down 30%, and this year it's up almost 30%. Last year you had size, small cap, down 15. This year it's up 18, right? So you see a lot of things that are flipping pretty dramatically. Last year profitability was up 24%. It's down 23% this year. So it's a pretty remarkable change of fortunes for these factors. And similarly for, some things like efficiency, this year is kind of the standout, up 40%. So that's things like asset turns and whatnot. Earnings quality, this is more like the slow and kind of accruals type of metrics, and those are up 20%. So, on the other hand, your defensive momentum, analyst revisions, stability, those type of things are generally struggling or even down quite a bit. Risk is a bit misleading, actually. Risk, what's called low vol, is not down at all. It's slightly up on a beta neutral basis. So this is dollar neutral, and when you're dollar neutral, the long side of low vol is very low vol. So there's a huge beta mismatch, and that's why it's down, just because the market's up. So that's completely misleading. This does not mean that low vol is down. That's why we actually show beta neutrality. But the one thing I really want to point out, and this will answer Dave's question, in Q1, the main outcome, and we've added this tracker down here called risk on and risk off. So we have an ex ante labeling of the factors, and we basically figure out ahead of time which ones are defensive, which ones are offensive. And essentially this is showing you that the risk on is up 12%, off is down 6%, and the spread is 18%. So if you were tilted the right way in this kind of risk on offensive manner, that posture got you 18% because, thanks to all of the MMT type of stuff that the market's pricing in, basically, this risk on risk off spread is showing you the impact of MMT, that the market's really pricing in all of that froth, and that's why you get that plus 18. And this, by the way, just shows you the long-term numbers that over 21 years, certain factors like deep value did really well. Why is this? I mean, this is really important to kind of keep in the back of your mind, because last year when, value was down 30% and had been down for several years pretty dramatically, and a lot of the prominent funds, the AQRs of the world, really, lost tremendous, saw huge redemptions because of that phenomenon. People had forgotten that the long term is actually still, value is still pretty much the best factor long term. So what we're seeing this year is a massive rotation back to the long-term mean. And that's really the lesson, is that, okay, there's huge cyclicality in these factors. You can have 5, 7, 10-year cycles where certain themes will underperform, but now we're going back to that sort of longer term, outperformance of value. But the fact that it's been so massively underperforming means that, okay, this actually has legs to run. I mean, this is not just a one-quarter phenomenon, we would think. And in fact, if you go back to Q4 of 2019, we were harping on the value rotation back in Q4. And in fact, we're kind of prescient in August, September, anticipating the first rumblings of such a move, which was really kind of taking shape till COVID happened. And then we, of course, acknowledged back in Feb of last year when Italy was on the front page that looks like the rotation's on hold because of the crash. So we know that going into a major dislocation, momentum is going to take off, value is going to get displaced. And so we knew that that was going to be a whole, obviously financials were going to be under stress, energy demand, oil demand would go down. So for all those reasons, the value rotation was on hold, but it's come streaming back now. And that shows up in some of these factors. If you look at the composite signals year to date, the value composite right here, you can see Q1 value composite up 20%. Simple combination of Val and Mo is up 27%. Now, these are really pretty enormous numbers. If you compound 27%, that's like 160 annualized. So, this is clearly not something we expect to annualize. But you can see how off the charts this quarter has been. It's been truly staggering that you've got 27% in simple combination of Val plus Mo, even though Mo has been sort of the momentum has not been great for us. So that's kind of what's going on here. And then you see that certain combinations of, our composites like the Fab 14 have done extremely well. So here you got 23.5%. And this is despite the headwind on the short side. So through the GameStop madness, the shorts were really hurting. And now we've got a situation where up until mid-Feb, the shorts were hurting, then the shorts backed off. So now let's say the shorts are flattish in Fab 14 and the longs are really kind of driving the boat. So you've got an extraordinary outcome because, the short side with all of the speculative names kind of backed off a bit and things are looking good. So in the interest of time, I'm going to skip over some of this, but basically once you got this powerful framework of the smart betas, you can build a risk model out of it and align your alphas better. You can do sector rotation just by looking at the signals aggregated across sectors. You can look at the return correlations and the cross-sectional correlations and all that sort of stuff. But one of the most important things you can do, which relates to this factor rotation, is to just classify the factors ahead of time, right? It has to be done ex ante, right? Because if you do it after the episode, that's cheating. So we've used our sort of we've done this, by the way, using some machine learning approach way back for the fund, and we were doing this to kind of time the factors. And so you can see during the crash, this is really kind of the litmus test for our classification, if you will, right? So if the classifiers has any outsample efficacy, right, then this should make sense. And you see what really happened here is that there's a 23% spread between the risk off, which we're up on average 17.5%, and the risk on smart betas, which were down 5.5% through the COVID crash. So pretty amazing kind of confirmation of this risk on, risk off approach. And subsequently in the rebound, it flipped. So the light gray bars against the dark blue shows you that, the risk off factors, as market came back, Fed stepped in, stimulus took off, then, the risk off, the defensive factors went down, the risk on went up. And that's pretty much what we see in Q1, but kind of on steroids. So Q1 has really been remarkable because the market's pricing in the trillions of the infrastructure bill potentially on top of the 2 trillion of the checks that are showing up in people's mailboxes and so on. And so guess what? I mean, you've got all these risk on factors like efficiency that are up 40%, right? And deep value that's up close to 30%, and small caps that are up close to 20%. And then you've got profitability. Who cares about companies making money, right? So you see this very perverse picture of what the market's really pricing in, and it's really a powerful lens to kind of look through. The day, sort of the decisive moment when all of this really kind of took place, by the way, was in November. So this is worth fixating on for a moment. What I'm showing you is Vaccine Monday. If you recall, back in November, we had 4 successive Mondays when there was big news, right? So November 9th last year was Pfizer. That was the day Pfizer got approved, and then the subsequent Monday was Moderna, and then there was some more news and some more news, right? So that happened every Monday in November. On the first Monday, the reaction was completely epic. So of absolutely historic proportions. And remember, this is just 6 days after the elections, right? So there's still some uncertainty looming, but the market's climbing the wall of where there's some huge resolution of uncertainty around the US elections, and the market's starting to rally. And then you get the Pfizer news, and all of a sudden, okay, the clouds have parted, blue skies ahead, and guess what? I mean, you got this massive risk on rally. So the risk on, risk off spread hit 7% in a single day, which I have to tell you is completely unprecedented. Those type of things do not happen in a single day, nor do you ever see momentum crash over 20% in a single day. So here what we're seeing is naive momentum factors down, you know, our sort of our vanilla momentum, smart beta is down 24%. Our enhanced momentum, which is meant to outperform, is down only 17.8. But regardless, this type of magnitude of a move, or minus 14, 15 on growth, is unheard of, while value is up 8%. So this is really kind of embodying that key pivotal moment when, you know, if you were looking at the heat maps real time, that bulb may have gone off in your head and said, okay, wow, this is happening. So that's kind of where we are, and the rest, as they say, is history. And I'm going to skip over some of this, but basically you can extrapolate this methodology into creating a crash factor and sort of expressing views on crashes. It works extremely well. Made you 52% last year. And then you can also look at, you know, exposures to factors for your given portfolio. We show it for one of our signals, the LBO signal, which, by the way, has tripled since last year. So this thing's up like 214% since the COVID lows of March last year, just about 1 year now. So yeah, that's kind of where we are. It's
Thank you.
Framework, but thank you, David, and back to you.
You're welcome. Let's walk over, if we can, if I can change the viewing on this to Sandbox, if I can, and we just want to go through.
Why don't I hit stop share and see if that works?
Great. Okay, so let's see here. Bear with me a second here. Bear with me a second here. Okay, so hang on here. Screen share. Bear with me a second. I may not, in fact, oh, here we go. And I'm just going to log into Sandbox for a minute. We have all of most of Milind's main factors on the Sandbox model. Milind, you able to see Sandbox on here on the screen?
I don't see it as yet. Maybe it's not sharing the screen as yet.
Sorry about that. Let's see here. Okay. Bear with me a second here. I don't think I'm able to access it. Let's see here. Let's try this one more time. And okay. Can you see the Sandbox screen there now, Milind? Or
Yes, now I see it. Perfect.
perfect. Bear with me a second here while we portfolio builder and factors. Okay, so this is the Sandbox portal, and in the Sandbox portal we have a fair amount of data, including hedge fund data, Canadian liquid alts, global ETFs, mutual funds, indices, etc. Actually, I may have to reset this actually here. Bear with me a second here. I let it sit too long. I think it timed out, but bear with me here a second here. What we're going to do is look at a few of Milind's factors and spend a minute building a couple of portfolios of their factors, and we just want to see how those factors compare to indices and other factors and possibly other factor funds. So here we go. So let's do this then. We have a function here called finder. And Milind, maybe you can walk me through as to maybe what I should do is look at these factors and yeah, basically on Sandbox we get a top sheet of every one of Milind's factors and a 50 plus of Quantz's factors from value to some of their very cumulative aggregated factors, such as the fabulous 14 you referred to earlier. I think an enterprise 18, which is a combination of various factors. So, and with these, we can add them to a portfolio and construct a portfolio of factors. In this case, we just built a portfolio of 3 factors equally weighted. those are the statistics on those factors. We can then increase the leverage of any one of them, and you can see in real time. The dark red line is the actual is the compounded return of these factors, both equally weighted, and as you change the weighting of one, the statistics change as well. So I just wanted to show you how this works. And all of the data on Sandbox, whether it be factors, whether it be mutual funds, whether it be ETFs, can be used in building portfolios and then saving portfolios, and you can also add your own data. So there we go. So let me just knock this back here. And Milind, maybe we can look at we have a tool here called Finder, and I thought we might look at a couple of other sort of factor products out there, and like AQR equity, maybe, possibly. Equity.
Why not?
Absolutely. So let's see here. Equity, AQR equity. So this is the AQR equity market neutral fund, I guess, as a mutual fund, I guess. And we have this facility here called Run Finder, and we can look at the AQR. So we're basically trying to understand how various investment products work, what they're correlated to, and when correlations break down. I think that's an important part of a portfolio construction tool. So we can look at the AQR product, for instance, and run it against Milind's factors. I think we can. And it comes up with these factors and the correlation to AQR. And do you want to pick one of these and make a comparison, Milind?
We just go with Fab 14, but this is fantastic. You know, the functionality that you can take a given manager's profile and sort of correlate or decompose it into the constituent factors, right? So you kind of know what factor bets they're taking. That's very powerful.
Exactly. So yeah, exactly. So the way these factors sometimes get described, if you've got a fund and you're looking at ETFs, if you see the preponderance of names, like they're all growth, okay, that's fine. You know, you say, well, okay, well, there's a sort of an odd sort of factor decomposition going on in this sort of correlation tool. And if they all show up, for instance, as tech, then you'd say, well, that manager's not a tech, but clearly that's where the returns are coming from. So in this Finder product, what we can do right now, they look not that correlated. But it's interesting. They may be correlated for a period, but what we have this thing called a stretcher, and we can see how they were correlated at 2 times leverage for a period of time. The AQR and Milind's and Quantz's Fabulous 14. They were actually quite correlated up until early 2000.
So for almost 18 years, if you levered up the AQR fund twice, you could have pretty much matched Fabulous 14, and then of course something strange happened.
Well, I can't speak to before 2014, but from 2014 to 2018.
I'm sorry, it's only 14. I apologize.
Yeah, sorry. Yeah. So they were, and then there was sharp divergence and went their different ways. So this tool is very, very, very useful, I think, for finding when they're correlated. So if you just look at correlation itself, it isn't a huge number, you know. I mean, it says, let's look at it, but it's not extraordinary. But if you can put a chart to it, that's very, very interesting. It was highly correlated for a period of time, highly correlated, and then it just diverged. So, and with the Sandbox product, you can look at all the factors and all of the products and all funds basically, and compare them in this sort of manner to find out not only when they're correlated, but when they're not correlated. So,
right. Yeah, that is really, I think, very powerful functionality, and something, you know, that we certainly encourage our users to kind of play around with. You know, it's nice that that you have this type of software where somebody can easily pull up the time series for our signals and smart betas, and, you know, correlate them to various ETFs or other indices and play around with that. It's nice
So
to.
all of Quantzy's signals are on the site, and people can build their own portfolios and then compare them, contrast them,
Yeah.
adjust leverage, and get a better understanding of how factors can work either as a kind of as a substitute, or as a fill-in, or as part of an investment model they'd like to utilize. Maybe you've actually come up all the combinations pretty well, but investors sometimes like to look at what they.
You want to show them how to do a simple val plus mo or something?
Sure,
So
absolutely.
you can just grab the value composite, the growth momentum composites.
Okay, you're going to have to tell me where on this they are. So value comp over here
is the growth mo composite, and then
the value comp down here, or is that which one?
Yes, the value comp being yes. Let's add that one.
There we go. Yeah. Okay. And
growth momentum is over here in the last column. That's the one. Yeah, that looks
okay.
And then let's compare it to Valmo. So there's another Valmo composite. So yeah,
Valmo.
I think it would just start it to the right. Yes.
That one, that's long only. That's long only.
Next to it.
Over here.
That's the one. That's right. Okay, so now what we're going to show is that if you take 50-50 of Val plus Mo.
Take a couple away here. Bear with me a second here. So we got a couple of others here. So I think these are the three, I think. So we got Valmo, Gromo. So anyhow, these are, go ahead.
Okay, so basically, if you keep the weight of the Valmo at 0 effectively, or 1 million in this case, and let's just try to increase the Valcomp and Gromo to 50 each, right, or max each, right? So that will become half Val plus Mo. Okay, now you see what's going on, right? Like you've taken the linear combination of the orange line, right? The orange line is your value composite, which was doing well and then crashed.
Right.
The growth momentum, the blue line, which has sort of been steady Eddie down below. And the average of those two lines is the red portfolio line, the dark red, that's sort of in the middle. The point I was actually trying to make is that it's really cool to use your slider feature to play with it and say, okay, if I just combine two-factor portfolios, I'm going to put 100 million in, essentially what you've done, right? 100 million in the value portfolio sort of sleeve, and then another 100 million in the momentum, growth momentum. The average of those two comes out to this number, right? Where you start with $1,000 and you end up with, looks like 5,000, what is it, 12,000? Okay. But then look at the other one, which is our Valmo composite, the other pinkish line up top, right? That ends up at 47,000. Right, so this is very interesting. You see how the linear combination, just taking the average of two-factor portfolios, does well, but not that well compared to taking the combination of the two in an integrated factor sense, which actually means that you're combining the scores of the two factors and then re-ranking the portfolio completely so that you end up buying the best stocks that are both high in terms of value and momentum, and then shorting the stocks that are worse, both in terms of value and momentum, right? As opposed to taking two separate portfolios, averaging the performance. Very different, a little confusing. But from the red lines, it's quite clear that the outcome is very different. 47,000 versus 14
and change. Yeah, exactly. And with this, you can go to Finder and then look at the portfolio. This is another way to render that red line we saw, and then you can search this for correlated ETFs or whatever you want. So it searches databases and comes back with results. So great. Well, listen, Milind, thank you very much. I really appreciate it, and it was very enjoyable listening to your thoughts on what's happening in factor rotation, and I think it conceivably could be very significant going forward. We'd look to take questions if anybody has any questions, and we'd look forward to hearing of them. So either you can key them in on the Zoom chat or possibly text us. Thank you again.